Hey, good morning, options traders, and welcome back, everyone. Well, in a recent video, I got a request from one of our traders asking what is the maximum price for a call option. So I did that video, we talked about it, and I also mentioned in that video there is also a minimum price for a call, and I said I would talk about that in a separate video. So here we are. So let's go take a look. What is the minimum price for a call option, and why does it matter? So let's go find out. And as always, before we do, please be sure to click like and subscribe. It's definitely very much appreciated and helps so much to promote the channel. So a call's minimum price is pretty easy to specify in a formula, but it's not quite so easy to understand why. And so here it is. The call option must trade for at least the stock price minus the present value of the exercise price or the strike price. So here's what it means. Let's say that the stock is trading for 100, and to make the math easy, we're just going to look at a 1-year $100 call. We're going to assume that interest rates are 5%. This would be the risk-free interest rate. And so let's start by finding the present value of the exercise price. The way that we do it, we take the exercise price, 100 in this example, and we divide it by 1 plus the interest rate, or 1.05. And it comes up to be 95.24. This is today's value of the strike price. So another way to think about this is that if you deposited $95.24 into a bank paying 5%, you would have $100 in 1 year. And that's what we're trying to find out is today's value of that $100 strike. So now take a look at what the formula says. Must trade for at least the stock price minus this guy right here, the present value of the exercise price. So let's take the $100 stock minus 95.24 equals $4.76. And so we know that this call option has to trade for at least $4.76. Now, sometimes people say, why do you use this long convoluted formula? Why not just take the cost of carry on the exercise price? And sometimes I talk about that just to make it easier to conceptualize, but it's really only true for an at-the-money option. And so people will say, well, if the interest you're earning on the $100 strike is $5, right? 5% on a 100 strike is $5. We could take the $5 divided by 1.05 and still get 476. And so notice we get the same answers. But sometimes when traders say, oh, let's make it easy and say it's the cost of carry on the exercise, again, that's only for at the money. Okay, so why is that? Well, let's look at our 1-year $100 call and say that let's call it the shortcut formula. Say the $5 of interest divided by 1.05 is 476. And so we say, okay, the $100 call has to be trading for at least 476. Then what's the 1-year $200 call got to be worth? Now think about that. We know that a $100 call has to be worth more than the $200 call because it's just deeper in the money, right? Lower strike calls have to be worth more money. And in fact, if the stock is trading for 100, this $200 call is probably not worth anything. But if we say we're just going to look at the cost of carry on the strike price, a $200 call would trade for twice that of 100. So see, now we would start getting into some ridiculous outcomes where the $300 call, the $400 call just keep having higher and higher minimums because the strike is higher, even though they're so far out of the money. So that's why we have to use this convoluted formula. So watch what happens when we take the stock price minus the present value of the exercise. So we take the $200 strike divided by 1.05, we get 190.47. And you can see if we take 100 minus that, see, now we get a negative number. So now it's telling us if the call's got to trade for at least negative $90, which of course makes no sense. We would just say it's got to be trading for at least 0. But if this number comes up to be positive, then we're on to something. All right, so that's why it's important to use this full formula. Now, the bigger issue is, why do we say that this has to work? How do we know that this has to be the minimum? Well, the answer is arbitrage. We've seen this in many past videos. Arbitrage is this concept of getting free money just from certain setups in the markets. We don't need any of our own cash, but it does create a guaranteed profit. So let's say that the stock is 100 and the 1-year $100 call is trading for 3. Now we just saw that it should be trading for at least 476. So it's too cheap. So here's what would happen. Arbitrageurs would short the stock. They would get this $100 credit. They would buy the $100 call for 3. Where do they get the $3 from? From the $100 credit. See, they don't even need their own money. This gives them a net credit of $97. They park that into an interest-bearing account, risk-free account at 5%, and they have 101.85 at expiration. But notice that they have to go buy back the short stock position. And what if it is trading well above 100, it's trading for 200, 300? No problem. Just exercise the call and pay 100. Where do you get the $100 from? Right there in your money market, 101.85. So that would give us an arbitrage profit of $1.85. However, this is really the minimum. Now, why is that? Well, if the stock is trading below 100, why exercise the call and pay 100? If the stock's trading for 95, let the call option expire worthless and pay 95 to close out the short stock, and you're just $5 ahead. So this is really the bare bones minimum. So the action of this arbitrage is going to put downward pressure as traders are shorting the stock, put downward pressure on the stock's price. They're going to put upward pressure on the call's price, and these two forces continue to work until the arbitrage is gone. In other words, until the call option is trading for at least the stock minus the present value of the strike price. So this arbitrage would look like this from a risk graph. Here's our bare bones minimum of $1.85, but notice if the stock is below 100, we can actually make more than $1.85, and that's again because we'll just let the call expire worthless. And we could actually make more, at least down to a stock price of 0. So the most we could actually make would be the 101.85 credit. That's assuming the stock goes all the way down to 0. So let's go put it to the test. Let's go over to the OIC's website and see if this is really true. Okay, so now we're into the OIC's website. That's the Options Industry Council. Got a nice little pricing model here. We're going to put the stock at 100, strike at 100. This is what we looked at in the example. 360 days to expiration, volatility 20%, and interest rates of 5%. And under these conditions, the call would be worth about $10.33. One way we can check for the minimum is to say, what if volatility were down at 0? Now, it won't let us put 0 in for an input, but it will let us put 1%. The idea, let's just make it so low that there's no volatility component to this option. But there is an interest rate component. So choose calculate, and there we go. There's $4.76. So now to also show why you can't just say it's the cost of carry on the exercise price, see if we made the strike 200, see using that logic, it would be $9.52. It would be double this. Well, that's just crazy to say that it's got to trade for at least that amount. See, the pricing model is saying it's worthless. So that's why I have to be careful about saying it's the cost of carry on the exercise price. You really have to say that it's the stock minus the present value of the exercise price. And if you get a positive number, that is the minimum that that call could trade for. Okay, so why is this so important to understand? Well, without it, traders can get misled. Let's say that we have an expensive stock. Let's say back when Amazon was trading for over $3,000. You're looking at a 1-year at-the-money option. And traders would see the prices. They'll say, wow, look at that, $280 for a call. It's because it's super volatile. Well, Amazon wasn't really that volatile. It was just an expensive strike. And so another way to check for that minimum, let's make volatility 1% again. You can see that you're paying about $87 of that is just for the cost of carry. See, it's not really so much the volatility. And so what happens a lot of times, traders will say, oh, let me go buy the stock and sell calls because look at the very rich premium I'm getting for this. Well, a lot of that is just from the cost of carry. It's theoretically the amount that you're missing out by having to take money out of your money market to buy the stock. So this is why it's important to understand that there is a cost of carry component to a call. We'll find out that's not true for a put, but there definitely is for a call. And so just understand that you can roughly think of it as the cost of carry on the strike if it's an at the money. And if not, you need to do that full formula. You can always do this too, throw it into a pricing model and just make volatility 1%. That's a little trick you can do to kind of see how much is coming from the cost of carry. But that's an important tool to understand to help you make better decisions. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.